You know, when you look at the world of investing, it really feels like there are two completely different games being played on the exact same field. So today, we're going to break down those two conflicting philosophies that are driving pretty much the entire market, from the speculative moonshots all the way to slow and steady wealth building.
And this all boils down to one big question you have to ask yourself. When you step up to the plate, are you trying to hit a massive home run, or are you just focused on consistently getting on base? Because trust me, how you answer that, it changes absolutely everything.
All right, so let's jump into that first game plan. This is the one that gets all the attention, right? All the headlines. It's the hunt for the home run. We're talking about that super high risk but potentially life-changing high reward strategy.
And this isn't some niche idea. As Eric Thiel over at Comerica Wealth Management points out, this mentality is, well, it's everywhere. The market is just flooded with people pitching you the next big thing, promising these insane returns. For a lot of folks, this is the entire game.
So what's the grand prize in this game? It's something called a 10-bagger. The legendary investor Peter Lynch actually came up with the term, and it just means an investment that goes up 1,000%. Think about that. Just one of these can totally transform your portfolio. It can make up for a whole bunch of other investments that didn't pan out.
Okay, so the million-dollar question is, how do you even find one of these? Well, according to some analysis from Insider Monkey, it's not just about throwing darts at a board and hoping for the best. You're actually looking for some very specific things. You want companies with truly disruptive business models, massive markets they can grow into, and of course, visionary leaders at the helm. And, you know, it's no surprise where you find them. You're usually looking in those big, game-changing sectors like tech, biotech, or renewable energy. That's kind of the breeding ground for these potential giants.
If you want a perfect, real-world example of this home run strategy in action, look no further than biotech, specifically the FDA approval calendar. Man, it really does not get much more high stakes than this. What we're talking about here are what investors call binary events. It's a fancy term for a pretty simple idea. A company's entire future, sometimes its very survival, comes down to a single outcome, a yes or a no from a regulator. It is, by definition, an all-or-nothing bet. And wow, this really puts the stakes into perspective. Just look at this sample FDA calendar. You've got companies going after huge markets, things like presbyopia and fibromyalgia, and look at the numbers. Potential peak sales in the hundreds of millions, even over $1 billion. Now, if the FDA says yes, that stock could just explode overnight. But a no, it could be absolutely devastating. That billion-dollar potential, that's the home run everyone is swinging for.
Okay, so if you thought biotech was high stakes, buckle up. We're about to go even further out on that risk curve. Let's talk about the speculative frontier, the quantum computing gold rush. This is a place where a company's value isn't based on today, it's based almost entirely on the promise of tomorrow. I mean, the excitement in this space is just, it's off the charts. You've got investors piling in, and they're all driven by this one really powerful belief, that we are right on the edge of a huge commercial breakthrough. A breakthrough that could literally change everything. We're talking medicine, finance, cryptography, you name it.
And the stock performance? It's been absolutely staggering. I mean, just look at Rigetti Computing. Over the last 12 months, the stock is up, get this, over 4,500%. That is a mind-boggling grand slam home run for anyone who got in early. But you gotta ask, what is actually driving that number?
Well, here's where it gets really interesting. This is the other side of that coin. That same company, Rigetti, with that incredible stock run, their revenue for the second quarter was just $1.8 million. And even crazier, that was actually down almost 42% year over year. So you have this huge, massive gap between the stock's performance and what the business is actually doing right now.
And this just goes to show you that even within the speculative world, there's a whole spectrum. On one end, you've got a company like BTQ Technologies. Their revenue, about $47,000. Its valuation is almost entirely built on hype and future tech. But then on the other end, you have a company like Inflection. They've got around $29 million in trailing revenue, with actual sales to big-time clients like NASA and NVDA. See, they're both home run type bets, for sure, but they are playing in completely different ballparks.
All right, let's hit the brakes and do a complete 180. We've seen the all-or-nothing home run hitters. Now let's look at the other game being played out there. This is what you might call the professional's playbook. And it's a totally different sport. It's a game of patience, of discipline, of hitting consistent singles and doubles.
And here we are, right back to that fantastic baseball analogy from Eric Thiel. The philosophy here is not about swinging for the fences and hoping you connect. It's about the exact opposite. It's about avoiding strikeouts. It's about just getting on base, consistently, and then letting all those small wins add up and compound over time.
So what does this actually look like in practice? Well, for starters, it means focusing on the big picture. So instead of chasing the latest hype stock, professional wealth managers are busy digging into the boring but important stuff, the macroeconomic data. They're looking at charts like this one on U.S. real GDP growth to get a real sense of the health of the entire economy.
And maybe even more importantly, it means focusing on risk. The goal here isn't to find the next rocket ship to the moon. It's about protecting your capital from major threats like inflation, which can just eat away your returns over time. That's exactly why they watch things like the Consumer Price Index or CPI so closely. It helps them make smart decisions about how to safeguard their investments.
Really? The heart of this playbook comes down to one word: discipline. It's about looking for economic resilience. It's about being really careful not to get caught up in the hype and overpay for popular stocks. And a huge part of it is smart diversification. That means looking for value in places others might be ignoring, like small caps or international markets. And it means using different types of assets, like real estate or alternatives, to build a portfolio that gives you a much smoother, more predictable ride. It's just a completely different way of thinking.
But here's where things get really fascinating. These two games, they're not always completely separate. You can actually bridge the gap. It's possible to invest in a huge home run theme, like AI, for example, but to do it with that disciplined base hit mindset of a value investor.
Let's take Micron Technology as a perfect case study. You've got the CEO of NVDA, Jensen Huang, the guy at the center of the AI universe, saying that Micron's high-performance memory is invaluable for the next generation of AI. So right there, that tells you Micron is a critical, essential player in one of the biggest home run sectors on the planet right now.
But now, check out the valuation cap. This is that value mindset in action. You've got a superstar like NVIDIA trading at over 40 times its forward earnings. But then you have Micron, which we just established is also a critical player, trading at around just 10 times. I mean, that is a huge discount for a company that's right at the heart of the AI revolution.
And this is where the opportunity really snaps into focus. There's a key metric investors use called the PEG ratio. Basically, it compares a stock's price to its earnings growth. It's a quick way to see if you might be overpaying for that growth. Well, for Micron, that number is just 0.19. And to put that in perspective, anything under 1.0 is usually considered a pretty good value. So what this suggests is that you might be able to get a home run growth story for a base hit price.
So, there you have it. We've looked at the two extremes. On one side, you've got the high-flying, speculative hunt for that next 10-bagger, and on the other, you have the slow, steady, disciplined game played by the pros, which of course brings this whole conversation right back around to you and your own personal game plan. Because at the end of the day, that's the choice every single one of us has to make. This market is full of rockets and roller coasters. It's full of wild speculative bets and super cautious plays. So the question is, how do you choose to ride? Are you going to step up to the plate and swing for the fences? Or is your game all about just getting on base every single time? There's no single right answer. It all depends on the game you decide you want to play.